Hey everyone, Clay here from Titan. I want to give you a quick pulse on what's happening in the markets and our opinion on what matters from here. It's May 1st today, and a lot's happened over the last month. We came into this week with a bit of a feeling of trade tension relief, of some rumors on some international trade deals happening, which gave the market a boost to start the week. But as we fast forward to middle of the week, we started to get some economic data that caused that optimism to fade quite quickly. We saw slowing payrolls, negative GDP growth the first time in 3 years, as well as sticky inflation. And so the optimism faded quickly, and it reminded people that there are some fundamental economic undercurrents that still give reason for pause. Fast forward another day to today, Thursday, and the likes of Meta and Microsoft reported pretty strong Q1 results and solid forward guidance. We have companies like Amazon reporting after the bell today. So earnings, if you look at the third of the S&P 500 companies that have reported roughly, about 3/4 of them have put up pretty solid numbers. They've beaten estimates. So we've had this roller coaster ride even over the last week and certainly over the last month, where positive news on the trade front is quickly followed by those rumors getting squashed and some more negative fundamental data putting some hair on the otherwise an improving narrative. Our take from here is that it's too soon to claim that we're out of the woods yet. Q1 numbers are in the rearview mirror. If you think about Q1 earnings, a lot of companies pre-bought. They pulled forward demand for sourcing their goods ahead of concerns that tariffs would make those goods more expensive. So when you look at the demand that companies saw from consumers or their own behavior on the enterprise side, Q1 doesn't give us a great sense for where the economy is heading. And there's still plenty of macro undercurrents that give us reason for pause. Stagflation is a real risk from here. We're not out of the woods in terms of the risk that we fall into a recession. So that underscores our strategy with our portfolios. So we have lower net exposure than we've had over the last few years. We've put out a lot of research to you all explaining why. And I think we're going to continue to hold that net exposure as is, but of course remain data dependent. So as the fundamental economic data, if and when it does improve, or we get some sort of Fed or Treasury intervention into markets, the liquidity backdrop starts to improve. If one or both of those two things start to happen, we'd get much more constructive, and that'd be a signpost for us to start adding an exposure and dipping back into the market in a bigger way. But until then, despite these fits and starts of optimism to pessimism, we think there's still plenty of reason for caution, cautious optimism, but plenty of reason for caution, and that underscores why we're going to stay active and tactical and follow the data from here.